This deal feels like it was long in coming. Everyone's been asking you, what are you going to buy? What are you going to buy? What are you going to buy? Tell me how you came up with this deal, and were there any other candidates that you looked at?
Well, thank you, Alex. It's great to be with you again today. You know, we've been talking about the need for consolidation in the business for quite some time. We need to put a value proposition and scale and size and resource quality together that really offers investors a different way to think about the E&P space. And that's what really done this with a transformative acquisition with Concho Resources, a great company that Tim Leach has built over a number of years. Just brings in a bunch of low cost of supply resource, 23 billion barrels into the company. It's about the assets. It's about a super strong balance sheet to really manage through the volatility that we see in this business. It's about how you allocate capital for value, not for growth. It's the distributions that we're committing to give back to the shareholder, and really it's about having a sustainable business that deals with what we know is an energy transition that's coming for our planet.
So can you give me some insight as to how competitive it was? Because if we really look at the shale companies that are worth buying, there's really only a handful, and Concho was one of them. So give me some perspective on that.
Yeah, so we're after quality. This is really putting two super quality companies together to create something that's really special in the E&P space. And when we talked about it, we're looking for companies, and we've said this repeatedly to the market, the all-in cost of the acquisition needs to be below our $50 cost of supply threshold. And then the ongoing development to compete for capital investment in the company needs to be below $40 cost supply. So that's the kind of resource that we're adding with Concho's huge position in the Permian Basin, both in the Delaware and in the Midland Basins. It's a great complement to our existing unconventional position. So we're going to be a unique company in this space with a huge position in the Eagle Ford, a large position in the Bakken, and now a super large position in the Permian Basin, along with our growing position up in the Montney in California. So we'll become one of the largest unconventional producers in the business today.
Ryan, good morning. It's Guy. The hurdle rate for many investors to put money to work in your sector is increasingly high. Can you just talk to me about what investors are telling you about this deal and why it makes sense? Why would I want to put money to work in your company, given all the headwinds that the sector faces? And how does this deal change that sort of calculation?
Well, I think, Guy, you have to look at the shareholder-friendly value proposition that we put forward. So we're going to modestly grow the top line of the company, and we're going to do that only on 70% of our cash flow. 30% of that's going to go back to the shareholder. And then you underpin that with a safe, growing, stable dividend that we offer, and you suggest the yield on that today. And you look at that free cash flow yield combined with that dividend yield, combined with top line growth. We think we're putting a value proposition out there that competes for value investors in this space. We're going to be able to do that through the cycle because of the strong balance sheet that we have. We can't predict what the prices are going to be, but we know if we're investing in low cost of supply resources, we can be resilient to that and have the balance sheet to manage through these different ups and downs. And that's what we're combining: great assets, great balance sheets together. And that's what makes it different. These are two great quality companies coming together to form an even better company going forward.
Hey, Ryan, not to get too nerdy for you at 10:04 in the morning, but something that Conoco is quite good at are decline rates and managing decline rates. Basically, it's how quickly that the well loses momentum. The lower, the better. You guys are pretty good, around 14%, if I'm correct, but Concho has a higher decline rate. Actually, I think Conoco's less than 14, but Concho has a higher decline rate. How are you going to manage it? How do you think about that?
Well, that's a great question, because that goes to the capital intensity. How much capital do you have to put back in to at least make your production flat, and then how much capital do you have to put in to grow? And we've got one of the lowest decline rates in the business because of our global diverse portfolio with this great unconventional production base, but also with these legacy assets around the whole world. Today, our decline rate's just about a little over 10% per year. This only moves it up to slightly right at 12%, and that's really over the next decade. It starts very similar to where it is today, grows a little bit over the next decade. And that's truly peer leading in this business. And that's why the capital intensity is low, and why it doesn't take a lot of capital for us to get top line growth in a very volatile commodity price environment. And we're committed to deliver excess returns back to the shareholder when we see the spikes in the commodity price. But we're able to be very resilient as those prices come back down, which inevitably do. We know that volatility is going to be there.
Walk me through some of the synergies, because Concho's also run quite efficiently. How are you going to extract that $500 million in synergies? How do you do that?
Well, so we announced the 500 million. It represents about $5 billion of net present value, or over $3.50 a share. So it is considerable, and it's well understood and well captured. There'll be G&A savings as we combine boards and corporate centers and do some of that today. But there's a big piece of that where we've made a strategic decision inside our company to reduce some of the new venture exploration that we're doing around the world. So as we bring these two companies together, we're creating a company with 23 billion barrels of resource that has a cost of supply below 40. Its average is below $30 a barrel. So we need to think differently about how much resource we're going to be adding in the next 10, 20 years through that exploration channel. So there's going to be some G&A and some capital reduction as we take our exploration program to down a little bit to fit the new reality of what this company looks like as we bring ConocoPhillips and Concho together. So we've got a really very well-defined idea about where these synergies are going to come from. We're going to get after them very quickly, and we expect to hit that run rate by the end of next year and as we go into 2022.
Ryan, why 100% equity? Was cash ever considered? Why this deal structure?
Well, we've talked about that with Tim and Concho and their board, and I think the really hard part about this guy is transacting it. What people might consider a bit of a cyclic low in our business, and that's really hard to do. We believe that there's going to be a transition as COVID-related demand destruction starts to recover in this business, and we see some slow recovery in oil price as the fundamentals, the supply and demand fundamentals improve over the course of the next couple of years. So taking all equity gives the Concho shareholders the ability to participate in that. And they're tendering into a much more liquid company on the market, and they're tendering into a very stable, growing, and substantial dividend that offers real return back to the shareholders. So I think when they looked at the combination of all that, 100% equity made sense.
Would the deal logic change?
Sorry, guys. Just on the ConocoPhillips side, it's accretive to all the financial metrics. So our shareholders should look at this and say, we're getting better earnings per share, we're getting better returns, and we're getting better free cash flow yield. So it makes sense on the ConocoPhillips side, too, to do this kind of a structure.
You talked a lot about ESG in the statement that I read. Does the logic of the deal stay as good with a Biden presidency were he to win?
Yeah, I think it transcends all of that. So we've laid out a Paris-aligned framework that is consistent with our climate strategy risk that we see as a company. And we understand that we've got three things we got to take care of. Is the world is demanding more action on climate change. We also need to deliver reliable and affordable energy to all four corners of the world because the growing population is going to demand that. And thirdly, we know that we've got to deliver financial returns back to the market. So what we've laid out in terms of a Paris-aligned strategy with emission reduction, intensity reduction targets for the next 20 years, down to a net zero ambition by 2050, is aligned with that, with the Paris agreements and what the world needs to do in order to keep the warming below 2 degrees Celsius.
Hey, Ryan, when do you tackle Scope 3 emissions?
Well, what we've said is that, our emission and our plans deal with the Scope 1 and 2 emissions. We advocate for a price on carbon. You've got to change consumer behavior. That's the way. We can't control how the consumers are using our product. And so we advocate, we've joined the Climate Leadership Council. We've advocated for quite some time that there needs to be a price on carbon in order to impact consumer behavior as we deal with this transition. So in science tells us that if everybody deals with their Scope 1 and Scope 2 emissions, you can reach a net zero target by 2050, consistent with what the international agencies are saying around the Paris-aligned agreement.
Ryan, it's hard for me to let you go without just asking your general take on the industry. OPEC Plus is meeting right now and talking about the supply and demand imbalance. From where you sit, what's a fair price for oil? What does supply and demand wind up looking like, and how are your operations running right now, where the pandemic is still out there?
Well, I have to give a shout out to all our employees. They've ran remarkably well through the course of this year. It's kind of been a lost year for many people, but I give a real call out. The operations are running really well. We curtailed, significant 400,000 barrels a day of volume at the peak of the downturn in the second quarter. That looks like to be the low. Things have started to recover. A little bit of sideways movement on price today at 41 is that we've had some resurgent resurgence in COVID, demand recovery not coming. We see it coming. We think we'll get some recovery by the end of the year, but it's probably a slower transition through the course of 2021 to get demand to pre-COVID kind of recovery levels. We see that happening, but probably not until the end of next year and into 2022. So we have to be careful about how we think about how much money to put into the growth vehicle and time that consistent with how we think the transition is coming and the recovery in price.